Retirement. It's the time, to finally kick back and relax and hopefully enjoy some financial peace of mind. But we all know that it takes planning, especially when it comes to like building an income stream you can actually rely on. So that's what we're diving into today. High yield dividend stocks for retirees. We're going to be dissecting a recent article from The Motley Fool, December 19th, 2024 to be precise. It's called Three High Yielding Dividend Stocks That Retirees Can Rely On for Recurring Income. We're going to unpack this article, highlight the most important points, and maybe even spark some new ideas for your own retirement planning journey.
Yeah, you know what's intriguing about this article? It focuses on just three companies, and it's not just a random assortment. We're looking at Bristol Myers Squibb, Enbridge, and Coca-Cola. So it's a mix of pharmaceuticals, energy, and, everyone's favorite beverage giant. It gives us a chance to see how dividend investing can play out across very different industries.
I love that. It's like a diversified portfolio in miniature, right?
Exactly.
Before we jump into the specifics, though, could you remind us why dividend stocks are often so appealing to retirees in the first place?
Absolutely. Imagine owning a piece of a company that actually pays you just for being an owner, right? That's the essence of a dividend stock. The company distributes a portion of its profits to shareholders, typically on a quarterly basis. It's like a little bonus check hitting your account, helping to supplement your retirement income, or even providing funds to reinvest and grow your portfolio further.
I always love a good bonus check.
Exactly.
Okay, so let's start with Bristol Myers Squibb, ticker symbol BMY. The article highlights their impressive 4.5% dividend yield, especially when you compare that to the S&P 500 average, which is hovering around, a much more modest 1.2%.
Yeah.
For folks who aren't Wall Street wizards, why is that difference so significant?
Think of yield as like the return you're getting on your investment, specifically from dividends. It's like interest on a savings account, but potentially much more lucrative. So that 4.5% yield means for every $100 you invest in BMY, you're potentially receiving $4.50 per year in dividends. It's a pretty substantial difference compared to the broader market average, which is why these high-yield stocks often attract a lot of attention from retirees seeking that steady income stream.
That makes perfect sense. But as we all know, investing isn't just about chasing the highest yields. The article also points out some challenges for Bristol Myers Squibb, particularly the looming patent expirations on some of their key drugs. So what does that mean for investors, and how concerned should we be?
Patent expirations, they're just, a fact of life in the pharmaceutical industry. When a drug loses its patent protection, generic competitors can swoop in and offer the same medication at a much lower price. This can significantly erode the original company's revenue and profits. It's not an immediate death knell, but it's definitely a hurdle they need to overcome. In BMY's case, some analysts are predicting this could impact their earnings in the coming years.
Oh, okay. That's not great news. But the article also points out some potentially exciting developments, namely the recent FDA approval of their new schizophrenia drug, Cobenfy.
This is where it gets really interesting.
Yeah.
The article mentions some analysts are projecting peak sales of Cobenfy could reach a staggering $7.5 billion. Now, projecting future sales is always a bit of a guessing game, but if those projections hold true, it could be a major win for BMY and potentially lead to even stronger dividend payouts down the line.
That would be incredible. But as we all know, relying on one drug is never a good idea. Luckily, the article mentions Bristol Myers Squibb has a very active pipeline with 51 compounds in development, focusing on over 50 different disease areas.
Having a robust drug pipeline is crucial for pharmaceutical companies. It's essentially their engine for future growth. It suggests they're not just relying on their existing products, but are actively investing in research and development to create the next generation of treatments.
So while patent expirations are a real concern, Bristol Myers Squibb seems to be taking proactive steps to address those challenges. They've got this potential blockbuster drug in Cobenfy, a diverse pipeline of new treatments in development, and let's not forget a solid 4.5% dividend yield right now. Let's move on to our next company, Enbridge, a Canadian pipeline company with the ticker symbol ENB. They're operating in the energy sector, which can be notoriously volatile. But the article makes a case for their stability, particularly for income-seeking investors.
What sets Enbridge apart from many other energy companies is their focus on pipelines and energy infrastructure. Instead of directly drilling for oil or gas, which is highly sensitive to fluctuating commodity prices, they transport it. Think of them like the toll roads of the energy world. They have long-term contracts with energy producers, guaranteeing a steady stream of revenue regardless of those price swings.
That makes a lot of sense. And that stability is reflected in their impressive dividend track record. We're talking 30 consecutive years of dividend increases. In fact, they just announced another 3% bump. They're currently boasting the highest dividend yield on our list, a whopping 6.4%.
That's certainly an attention-grabbing number. But as always, it's important to look beyond just the yield. We need to consider the sustainability of those dividend payments. In Enbridge's case, their consistent earnings growth and predictable revenue streams, thanks to those long-term contracts, provide a strong foundation for continued dividend increases.
The article also mentions some strategic acquisitions Enbridge has made this year, specifically in the U.S. gas utility space. They're aiming to boost efficiency and potentially tap into new growth avenues. How do these acquisitions fit into the bigger picture for Enbridge, and how might they impact investors?
Acquisitions can be tricky, but in this case, it seems Enbridge is focusing on strategic expansion. Not just buying up companies for the sake of it, they're acquiring gas utilities, which are often regulated businesses with predictable earnings, further enhancing their stability and potentially creating new opportunities to increase dividends in the future.
So we have a high-yield dividend stock, consistent dividend growth, a business model that's somewhat insulated from the volatility of energy prices, and a strategic focus on growth through acquisitions. Enbridge definitely seems like a contender for retirees seeking that reliable income stream. Now, let's take a break from the world of pipelines and energy and step into something a little more familiar. Coca-Cola. Everyone knows they're iconic beverages, but what makes them stand out as a potential dividend powerhouse for retirees?
Coca-Cola. Well, they're a classic example of a blue-chip stock. They have a globally recognized brand, a diverse portfolio of products, and a history of remarkably consistent dividend payments. In fact, we're talking 62 consecutive years of dividend increases. That's not just impressive, it's almost legendary.
That's incredible. 62 years. What has allowed them to maintain that consistency for so long?
Several factors contribute to Coca-Cola's remarkable track record. Firstly, they operate in the consumer staples sector. People tend to buy essential products like beverages, regardless of economic conditions. This gives Coca-Cola a degree of stability that many other companies envy. Secondly, they've demonstrated incredible pricing power. Think about it. Have you ever noticed a dramatic drop in the price of a Coke? They have the ability to raise prices without significantly impacting demand.
I can't say I've ever seen a fire sale on Coke.
Right.
And they're not just relying on their namesake beverage either. They've got an incredibly diverse portfolio of brands, including Sprite, Fanta, Minute Maid, and many others, spanning a variety of categories.
That's right. That brand diversity provides them with multiple avenues for growth and helps to mitigate risk. If one brand or product category experiences a slowdown, they have others to pick up the slack. This multifaceted approach has been key to their consistent profitability and dividend growth.
And speaking of growth, while their 3.1% dividend yield might not seem as flashy as Enbridge's 6.4%, they just announced a very generous 5.4% dividend increase.
It's a testament to their commitment to rewarding shareholders. While the current yield might not be the highest, that consistent growth and their incredible track record of increasing those payments over 6 decades make them a very appealing option for retirees seeking reliable and growing income.
That's fascinating. We've now covered 3 very different companies. Bristol Myers Squibb, with its potential for pharmaceutical breakthroughs, Enbridge, with its steady pipeline of energy profits, and Coca-Cola, with its iconic beverages and remarkable dividend history.
It's quite a lineup. Each company offers a unique value proposition for retirees seeking to build a diversified portfolio of dividend-paying stocks.
So far, we've only scratched the surface. We've established why these companies are on the radar for retirees seeking dividend income. But we need to dive deeper into their financial health, their growth prospects, and of course the risks involved. We'll do just that in part 2. Stay tuned.
It's fascinating how each of these companies, occupies a different space on that risk-reward spectrum. And understanding that is crucial for making, informed investment decisions, especially when you're talking about retirement funds.
That's a great point. It's not just about chasing the highest yield.
Right.
We need to consider the level of risk we're comfortable with. So where do these companies fall on that spectrum? Let's start with Bristol Myers Squibb. They're in the pharmaceutical industry, which is known for its innovation and potential for huge breakthroughs, but also for its, inherent risks.
Absolutely. With pharmaceuticals, you're dealing with a lot of unknowns. Developing new drugs is a long, complex, and expensive process. There's no guarantee that a drug will make it through clinical trials, gain regulatory approval, or even become a commercial success. And as we discussed earlier, patent expirations are a constant threat, potentially eroding profits when generic competitors enter the market.
So while Bristol Myers Squibb has this exciting new schizophrenia drug, Cobenfy, and a strong pipeline, there's always the chance things could take an unexpected turn. It feels a bit like a high-stakes gamble, doesn't it?
In a way, yes. But it's important to remember that Bristol Myers Squibb isn't some fly-by-night startup. They have a long history of successful drug development, a deep understanding of the regulatory landscape, and a strong financial position. It's not a risk-free investment by any means, but they're not exactly rolling the dice either.
That makes sense. So maybe not a gamble, but definitely a company for investors who are comfortable with a bit more volatility and uncertainty. Now, what about Enbridge? They're in the energy sector, which can be even more unpredictable than pharmaceuticals. How would you assess their risk profile?
Enbridge's risk profile is interesting because it's, somewhat different from traditional oil and gas companies. Remember, they're primarily focused on pipelines and energy infrastructure, not exploration and production. This means they're less exposed to the wild swings in oil and gas prices that can wreak havoc on those companies that are actually drilling for those resources.
Right, they're the transporters, not the prospectors. It's like the difference between owning a gold mine and owning the trucks that transport the gold.
That's a great analogy. Enbridge's revenue streams are more predictable because they're based on those long-term contracts we talked about, but they're not completely immune to risk. Regulatory changes, environmental concerns, potential pipeline leaks or accidents, those are all factors that investors need to consider.
So they're not quite as steady as a company like Coca-Cola, but not as potentially volatile as a pharmaceutical company. Where would you place them on the risk spectrum?
I'd say they're somewhere in between. They offer a good balance of stability and potential for growth, but with some inherent risks that investors need to be aware of.
All right. That helps to paint a clearer picture. So we've talked about risk, but what about growth potential? Which of these companies has the most runway ahead of it, and what factors will likely drive that growth?
Growth is a multifaceted concept, and it depends on your investment horizon and how you define growth. Bristol Myers Squibb, with its focus on developing new drugs, has the potential for the most dramatic growth if those drugs are successful. A single blockbuster drug can dramatically change a pharmaceutical company's fortunes.
It's like hitting a home run in baseball. It can change the entire game.
Exactly. But as we've discussed, pharmaceutical development is a long game with lots of uncertainty. Coca-Cola, on the other hand, represents a different kind of growth story. They're a mature company operating in a well-established market. Their growth is likely to be more steady and predictable, driven by expanding into new markets, introducing new products, and strategically acquiring promising brands.
So not necessarily explosive growth, but a steady upward trajectory.
Exactly. And let's not forget their incredible track record of dividend growth. For many investors, particularly those in or approaching retirement, consistent dividend increases are a key component of total return.
That makes a lot of sense. Now, what about Enbridge? How would you assess their growth prospects?
Enbridge's growth is closely tied to the demand for energy, especially in North America. As long as people need oil and gas, Enbridge will likely continue to benefit. They're also strategically positioning themselves for the future by exploring opportunities in renewable energy and other areas, which could become significant growth drivers down the road.
So they're not just sitting back and watching the world change around them. They're actively looking for ways to adapt and evolve. That's encouraging.
Absolutely. But it's important to note that the energy landscape is changing rapidly. The transition to cleaner energy sources is gaining momentum, and that could eventually impact demand for traditional fossil fuels. It's something that investors need to keep a close eye on.
All right, so we've got Bristol Myers Squibb with its potential for blockbuster drug-driven growth, Coca-Cola with its steady, reliable expansion, and Enbridge navigating the evolving energy landscape and seeking new avenues for growth. It's a lot to take in.
It certainly is. But understanding these dynamics, the risks involved, and the potential rewards, it's essential for making informed investment decisions. It's not just about chasing the highest yield or the most exciting growth story. It's about finding the right balance for your individual needs, your risk tolerance, and your investment timeline.
Well said. We've covered a lot of ground here, exploring these companies from multiple angles. In Part 3, we'll distill all this information into some key takeaways and actionable insights for our listeners. Stay tuned. So, we've journeyed through the world of pharmaceuticals with Bristol Myers Squibb, navigated the pipelines of energy with Enbridge, and sipped on the sweet success of Coca-Cola. Now, let's distill everything we've learned into some key takeaways, for you, for our listeners.
What strikes me most is how this article by showcasing these diverse companies, highlights the power of diversification.
Yeah, it's like building a well-rounded team, each player bringing their unique strengths.
Exactly. You wouldn't want a basketball team of all point guards.
Right, right.
The same principle applies to investing.
I like that analogy.
Bristol Myers Squibb, with its focus on innovative drug development, offers the potential for high growth, but also carries a higher level of risk, right?
Yeah.
It's a company for investors who are comfortable with a bit of a roller coaster ride.
Yeah, they're the high flyers, aiming for those slam dunks, but sometimes they might miss the basket.
Exactly, and that's where Enbridge comes in, right? They're offering a different kind of play. They're the steady, reliable point guard, consistently moving the ball down the court with those long-term contracts and predictable revenue streams. They offer a solid dividend yield and a history of consistent growth, appealing to investors seeking a more balanced approach.
They might not be scoring those flashy three-pointers, but they're racking up points steadily and consistently.
And then we have Coca-Cola, the seasoned veteran, the coach on the sidelines who's seen it all and knows how to win no matter the economic climate. They're the anchor of stability. The company you can count on to deliver consistent performance and dividend growth, even when the market gets a little rough.
They're the ones calling the plays, making strategic adjustments, and guiding the team to victory year after year.
It's fascinating how each of these companies, appeals to different investor personalities, right, and risk profiles. There's no single best dividend stock. It's about finding the right fit for, your individual needs and goals.
Exactly. It's like choosing the right tool for the job. You wouldn't use a hammer to tighten the screw.
Right.
Similarly, you want to select investments that align with your financial objectives, your risk tolerance, and your time horizon.
And this brings us to another crucial takeaway: the importance of understanding your own investor personality.
Oh, that's so important.
Yeah. Are you someone who thrives on excitement and is willing to embrace, a bit of risk for the chance of higher rewards? Or do you prefer a more conservative approach, prioritizing stability and consistency above all else?
Yeah. Are you a gambler or are you playing it safe?
Knowing yourself is key to making sound investment decisions. It's about finding that sweet spot where your comfort level intersects with your financial goals. Don't just blindly chase the highest yield or the most hyped up growth story. Do your research, understand the risks involved, and choose investments that truly align with your overall financial strategy.
And speaking of research, this article we've been discussing is a great starting point, but it's just the tip of the iceberg. I mean, the world of investing is constantly evolving, and even the most seasoned veterans are always learning and adapting. Never stop seeking knowledge, exploring new ideas, and challenging your assumptions.
I love that. Curiosity is the fuel that drives, informed decision-making. Don't be afraid to dig deeper, read different perspectives, and ask questions. The more you know, the better equipped you'll be to navigate the complexities of the market and make choices that, empower your financial future.
This deep dive has given us a lot to think about. We've explored the nuances of dividend investing, analyzed these three compelling companies, and most importantly, I think, emphasized the importance of understanding yourself as an investor. Remember, there's no one-size-fits-all approach. It's about finding the strategies and companies that resonate with your individual goals and risk tolerance. Keep learning, keep exploring, and keep striving toward your financial dreams.